My name is Jason Leavitt. I'm head of research at Leavitt Brothers. Leavitt Brothers is a boutique research firm which offers market analysis and trading ideas to investment advisors, hedge funds, and full and part-time independent traders. We solve the problem of knowing what side of the market to be on and what to invest in at any given time. This is my third time speaking at Investor Inspiration. Part 2 was a continuation of part 1, and today's part 3 will be continuation of part 2. So I guess you can say it was one big webinar, which I broke up into 3 different parts. I'm going to review parts 1 and 2 so that we're all on the same page. Some of you have probably seen parts 1 and 2. They're saved on YouTube. I'll discuss that in a second. But I need to get everyone on the same page before I jump into part 3. If you haven't seen part 1, you can find it on YouTube. Here's a screenshot. You can just do a search for that, and I'm sure it'll come up at the top, or at least on the main page, so you can easily find it. In part 1, I talked about the essence of trading. In my opinion, learning the nuts and bolts does very little good if you don't have the right frame of mind. If you don't have the right reference point to begin with. Many traders learn the hard way that chasing consistency is a trap. They think that if they come up with some sort of system that wins 60% of the time and makes more money on the winners than it loses on the losers, that over time, over the course of hundreds of trades, they'll make money. But this is actually a trap. Most profitable traders only win like 30, maybe 40% of the time. So calculating wins and losses doesn't even make sense, because if you have a small win, small win, small win, and then a huge win, like taking the average of that doesn't really tell you anything. Okay. The key for most big traders is they have outliers. They have occasional big winners. Profitable traders also undertrade. Instead of distracting themselves with many average trades, they restrict themselves to only trading the very best. Okay. Here are a few quotes. I'm going to go through a few quotes that capture what I consider to be the essence of good trading. Okay, this is from Charlie Munger. He's Warren Buffett's right-hand man. He's been there for like 50 years. He said, a few major opportunities clearly recognizable as such will usually come to one who continuously searches and waits with a curious mind, loving diagnosis involving multiple variables. And then all that is required is a willingness to bet heavily when the odds are extremely favorable, using resources available as a result of prudence and patience in the past. Okay, that's kind of a mouthful. Let's read it backwards. He said, using resources available as a result of prudence and patience. Okay, so he's saying, be patient, wait for a good one, and when you get a good one, you'll have money available to put to work. Before that, he said, a willingness to bet heavily when the odds are extremely favorable. Okay, so when you get a really good one, you can't just take an average size position. You must size up and go for the jugular. In fact, Munger himself has admitted that most of Berkshire's gains over the last 50 years have come from just 15 investments. And finally, he said, a few major opportunities. Okay, he didn't say 100 trades each year. He said a few. That's it. Okay, so the essence of good trading is have patience, a few major opportunities, bet heavily. Okay, I'm going to do 2 more quotes that capture the essence of what good trading is. Richard Dennis, he's of the Turtle Trader fame. He said, you have to minimize your losses and try to preserve capital for those few instances where you can make a lot in a very short period of time. What you can't afford to do is throw away your money on suboptimal trades. If you do, you'll be too debilitated to trade when the right positions come along. Even if you put the trade on, it will be relatively small because your capital and confidence will have been depleted. Okay. So again, he said, minimize losses, preserve capital, and don't engage in suboptimal trades. He's saying he's talking very similarly to Munger, where he's basically saying preserve. Munger said have patience. Richard Dennis is saying preserve capital. Both of them are saying don't engage in average trades. Both of them are saying you have to kind of go for the jugular when you have the opportunity. Let's do one more. Stanley Druckenmiller, who traded for George Soros for a while, he said the way to build superior long-term returns is through preservation of capital and home runs. The few times Soros ever criticized me was when I was really right on the market and didn't maximize the opportunity. Okay, so he said preservation of capital and home runs. Okay, again, saying essentially the same thing. Okay, so a lot of people they think of trading in an incorrect way. Okay, the essence of good trading is not getting consistent results. It's not having a high winning percentage. It's not developing a strategy that works 52.6% of the time or something like that. Okay, instead, the essence of good trading is preserve capital and only trade the good ones. 2, keep losses small. And 3, press the accelerator and maximize opportunities when you get them. Okay, most traders know they need to keep losses small. After a while, most realize they're better off restricting themselves to only the very best setups instead of taking every average one that comes by. But almost no one fully grasps the need to size up and be aggressive when given the opportunity. It's not sufficient to cut losers and ride winners. You have to actually add to winners. Okay, the best analogy for good trading is poker. Okay, how do you play poker? You certainly don't sit down thinking you're going to win every hand. Heck, you don't even think you're going to win half the hands. In fact, most good poker players sit down thinking that they just need to win one hand every hour. Okay, good poker players think about folding when they don't have good cards and pushing it when they do. Okay, sound familiar? A poker game starts and you have to make a starter bet to play. You got to put money on the table in order to play. If you're dealt crappy cards, you fold. You keep your loss small. But if you have good cards, you add to your bet. Then the dealer flips over a few cards. Based on the cards you have and the cards available on the table, you again have to make a decision. You either fold or you add to your bet. Even if you don't play poker, you still get you still have an idea how the game works. It's a perfect analogy for trading. If you have good cards or sense a good opportunity, you add to your bet and keep pushing it. If you don't, you fold and keep your loss as small as possible. A good poker player will lose several hands in a row, and then when he has a good opportunity, he strategically pushes it in order to win the biggest pot possible. Okay, I think we can all agree that if a poker player has a great hand, it would be completely unacceptable to not fully take advantage of that. Trading is literally identical. Only play the best setups, keep losses small, and every once in a while, when you get a great opportunity, maximize it. Just like in poker, it would be totally unacceptable to not fully take advantage of an opportunity. I'm sure we've all had trades where we got in, it worked out really well for us, we got out a month or two later, and then we sat back and said, I should have taken 2, 3, 4 times the position and I would have been much better off, okay? That is the essence, that's part of the essence of trading, is that really good traders don't just ride winners for a little while, but they actually push it and size up with those winners. Okay, this is what I talked about in part 1. Okay, I didn't talk about the nuts and bolts because without the proper approach, without the proper mindset from the beginning, a great system won't do you much good. You'll end up like one of those traders, as I just said, who buys a stock at 20 and sells at 22 and then watches it rally to 40. Okay, who cares if you have a great system that gets you into a stock at the perfect time? You missed most of the move. Okay, coming off of part 1, everyone was thinking, okay, I get that the essence of trading is restricting yourself to only the very best setups. And then a combination of keeping losses small and pushing the accelerator will maximize profit potential. The next logical question was, how do you identify those setups? Where do they come from? What do they look like? That's what I talked about in part 2. Here is a screenshot. So I did part 2 about 6 months ago. It was recorded and posted on YouTube. So again, you could do a search for it. It was about 45 minutes long. So in part 2, I talked about how over time, 80 to 85% stocks will underperform the market. Okay, it doesn't seem to make sense. You'd think like, hey, the market will trade and half the S&P will do something and half the stocks will be better and half the stocks will be worse. But actually, when you have a stock like Netflix, which goes up 2,000%, you have like 20 or 30 or 40 stocks that underperform. Facebook, Tesla, Google, pick any of the big stocks that have gone up 10x, 20x over the last couple of years. And for each one of those stocks, you have to have 20 or 30 or 40 stocks that underperform. So actually, most stocks are on par with the market or even worse, and very few stocks actually outperform. Okay, let's say this is the distribution of gains and losses for each stock in the S&P 500. Okay, the average is 12%, just say as an example. But as you can see, most stocks underperform while a much smaller percentage outperforms, and an even smaller percentage outperforms by a large margin. This is typical. Over time, whatever the market does, most stocks will do worse. Only 15 to 20% will do better, and only about 10% will truly do great. And when a stock does worse, it doesn't mean it's doing bad. You know, the S&P can go up 10% and a stock can go up 5%. It just means that most stocks are on par with the market or worse. Some do a little bit better, some do a little bit worse, and very few outperform by a wide margin. That means if you really want to do great and nail big moves, you have to be in stocks that outperform by a wide margin. It's the only way. If you want to beat the market, you have to be in some of the stocks that are on the far right side of this histogram. Okay, to tie this in with what I discussed in part 1 of my talk, if you're looking for one good trade every once in a while, instead of consistently average trades, then you need to be on the right side of that histogram. Okay, you need to be focused on stocks that are outperforming, because that's where the big winners will come from. Okay, and then in part 2, I also talked about how to find the best stocks in the best groups. So now in part 3, I'm going to talk about my favorite setup and how I trade it. All right, my favorite setup can be found on a weekly chart, where I use a 30-week moving average. Okay, sometimes I use a 20, other times I use a 50, but at the very least, I start with the 30. It's at least a place to start. Okay, stocks have their own personality, so sometimes you have to tinker around with different moving averages to find out which one kind of is in sync with that particular stock. Okay, so here's the setup. A stock trends down under its declining 30-week moving average. Okay, during this time, I have no interest whatsoever. Okay, I don't pick bottoms. I want to ride a trend. I want to ride an uptrend, preferably. And I have no desire to guess when the trend will begin. Okay, I'm perfectly happy to miss the beginning of a move. Let the fundamentalists, let the people who know the company better, let the big money who needs to average into positions, I'll let the other traders neutralize the stock and start to push it up. And I'll miss the first 10 or 20%, that's perfectly fine. I want to grab the middle chunk of a bigger trend. Okay, so stock trends down on the weekly chart under its 30 moving average. Okay, then you get a volume move through the moving average. Okay, this gets my attention. It doesn't matter why it happens. It could be just a technical move. It could be somebody knows something. It could be they beat earnings. It doesn't really matter. If you get a volume move through a significant moving average, that gets my attention. Okay, there are no guarantees that the trend is going to change, but at this point, the stock at least gets on my radar. After this, one of three things happens, or I'm looking for one of three things to happen. One, the stock will come back down, test the moving average, and then it'll move up, take out the high, or the most recent high, and then begin an uptrend. Okay, sometimes there's one test of the moving average. Sometimes there are 2 or 3 tests over the course of several months. Now remember, this is a weekly chart, so if this was a candlestick chart, every 4 candles is an entire month. Okay, this is a longer term setup. You're looking to ride a trend for 3, 4, 5, 6 months, and sometimes they take a couple months to set up. Okay, so this is what I'm looking for. Comes down and tests, then takes out the high, while the moving average will start to curl up. This tells me the stock, which was trending down, starts to neutralize, and then it starts to trend up. This is the beginning of a trend up, and then I'm looking for retests of the 30. Okay. Another thing I'm looking for is the stock trades in some sort of easily definable pattern and then breaks out. Okay. During this time, the moving average will flatten out and then start to curl up. It's as if the stock used so much energy to get above the moving average that it needs to rest for a few months before officially beginning an uptrend. Okay. Another thing, the third thing I look for is somewhat similar, is that the stock just trades very sloppily above the moving average and eventually continues up. There can be lots of up and down movement. There can be a lot of gaps, no clear pattern, no clear support and resistance, just a lot of sloppy action while the moving average flattens out and starts to curl up and starts to support the stock. Then the stock rides the moving average up, and if you're lucky, it'll hit some sort of an inflection point and accelerate. All right, so again, my goal is to nail a big move every once in a while. Okay, not a bunch of average moves, not a bunch of little moves. Once in a while, I want to nail like a really good move, and to do that, I find them on the weekly charts. Okay, and I also know that I'm going to have to hold for several months. Okay, you're not going to nail big moves constantly trading in and out of positions. You're shooting for big moves that last several months. And this is a great way to identify really good setups on longer term weekly charts with a key moving average. Let's look at some examples of each after I get a drink. All right, so here's Caterpillar. Okay, the stock trended down for a while. Okay, it bottomed and then rallied. It bottomed, rallied pretty hard off its low with several big volume weeks. You can see the blue arrows here, which point out the volume, so it gets through the 30-week moving average. Okay, then after breaking out and moving up, twice it came down and tested the 30-week moving average, came down, tested here, came down and tested moving here. Okay, and then it broke out and it ended up trending up. Okay, during a time the S&P moved up 25%, CAT moved up 100%. Okay, so it's an example of a stock that was on the far right side of the histogram I showed. This is what I'm looking for. A stock trends down and suddenly jumps above its 30-week moving average on strong volume. Then after resting, it begins an uptrend. Okay, the pattern here took 3 to 4 months to form. Okay, when I see this happen, when I see a stock that was down and depressed get above its 30, it shows up on my radar and I say, okay, this stock has the potential to be reversing. It could trend up for several months. And what I'm looking to do is I'm looking for evidence that buyers will actually come in at a significant moving average. And if that's the case, I'm looking to buy starter positions at the moving average or close with tight stops. So if it goes against me, I'm just out with a small loss. If it goes in my favor, then I'm adding to my position again when it breaks out. Okay, so if I buy at the moving average or close to it, and it goes against me, I'm going to lose small. But if it actually does reverse and continue up, then not only am I going to win, but I'm going to win bigger because I'm going to be adding to my position as it goes. Let's look at another one. Vale, I think is how you pronounce it, Brazilian company. The stock trended down for several years. Okay, remember, I have no desire to guess a bottom. Okay, I don't care about missing the first 10 or 20%. I'm looking to nail like a big. I'm looking for a trend to develop, and I just want to nail the middle chunk of it. I don't care about the beginning, and I'm not going to get out at the end. I'm looking to nail the big chunk in the middle. Okay, so Vale surged above its 30-week moving average here. You can see the big candle here, big volume. And then it spent several months. I mean, not just several months, but like we're talking like 6 or 8 months forming an ascending triangle pattern. Okay, resistance was easy to identify. The 30-week moving average supported the stock on 2 occasions. To me, this is as perfect as you get. It's an absolute no-brainer. Trades don't come better than this. Okay, for a stock to trend down, get above its 30 or some other significant moving average with a big jump in volume, comes down and tests a couple months later, goes up and tests the high, comes down and tests the moving average again, and then moves up and breaks out, and you can see the volume at the breakout and for the several weeks after the breakout was very strong. This is as perfect as you get. If you restrict yourself to only trading this type of setup, you'll trade much less, but you'll make a lot more money. Okay. The stock doubled from its breakout level, and if you consider entries along the moving average, the gain was much bigger. This was obviously a stock on the far right side of the histogram, and of course, it was one of the stocks we recommended at Leavitt Brothers. It was as perfect as you get. As far as how I play this, again, when it gets above the 30, I'm not in that trade. Okay, stock went from 2 to 6, and like it takes that kind of a move to get my attention, but it goes on my radar. When it pulls back, I'm wondering, is it going to find support? Is it going to just go up, come all the way back down to 2? It's going to be one of those stocks that trades in a range above and below the moving average. So I'm looking for evidence that buyers will actually come in at the moving average. And when I see that that's the case, when I have an entry that gives me a tight stop, take a starter position, and as it develops, I see that this thing is looking more and more bullish. You can see volume over here, volume ramped up over here. You can see down volume is not very high. It just has a really good, smooth, pretty pattern, and you can see how it played out. All right, let's look at another one. Here's Advanced Micro Devices. Okay, this was a stock that didn't do much for like 10 years. Okay, it moved down and over and seemed to be falling behind a lot of its peers. In fact, there were a lot of reports out there that this company didn't even need to be in business, that other companies were doing the same stuff, and there was no reason to have duplication in the field, and there was just no reason for them to be around. But after basing for a really long time, it actually jumped above its 30-week moving average here. You can see back here in early March, there was a pickup in volume when it did it, and it matched its previous high. At that point in time, it doesn't really get my attention because the stock had been dead money for so long and it traded above and below its moving average for so long that it's not noticeable when it's finally in the beginning stages of an uptrend. And of course, back here, you don't know that it's in the beginning stages of an uptrend. Then it actually breaks out at $3 with a big volume surge. Okay, at that point in time, it gets my attention. Okay, because the volume, the move, the multi-month high, it starts to get my attention. Then it proceeds to just trend up, and it doesn't really pull back to the moving average. It just kind of trends up for several months. So I'm watching it. I'm wondering if this stock really is turning the corner. And as it keeps going and going and going, I've kind of decided that, like, yes, indeed, it is turning the corner, and I probably missed an entry. And so I wonder if I'll ever get a chance. And then it trades into a 4-month pattern here where it moves sideways. It falls pretty good, and then it puts in a lower high, and then it comes in and puts in a higher low. Essentially, it waits for the moving average to move up. Okay, so it trended up from like $3 all the way to 8, and then it came down, and then it moved sideways for about 3 or 4 months, waiting for the moving average to move up to catch up to it. You can see that the stock found support at the moving average here, and again in the middle of the pattern, and pretty close to right here too. So the way I'm playing this is that I recognize that this is a stock that was weak, that has now turned the corner and is trending up. I'm looking to buy dips within the pattern with tight stops. If I lose, I lose small. If the stock moves up, then I add to my position and I end up winning big. The stock eventually broke out and continued up. So if you got in early, you made several 100%. If you got in like me, you basically doubled your money. This is an example of something that I post at Leavitt Brothers. Okay, at Leavitt Brothers, we have 2 different lists. We have a shorter term list that I post with daily charts, where we're just looking for quick trades, that might only last a couple of weeks. And we have a longer term list where I post with weekly charts, where we're looking for these types of setups that last potentially like 6 or 8 months. All right, let's move on to another one. Okay, here's Extreme Networks. It was a beaten down stock. It got above its 30. Then it moved up a little bit and formed a pretty recognizable pattern above its uptrending moving average. Okay, positive volume was really strong in the pattern. You can see, big block, not big, but decent volume here, certainly not huge, but above average. This to me was another no-brainer trade. Okay, starter positions are in order along the bottom of the pattern near $4. Okay, and then the position could be added to on the breakout. Okay, the stock more than doubled over the course of 6 months. Obviously, it was a stock on the right side of the histogram. Okay, so this is exactly what we're looking for. Okay, this is exactly what you're looking for. Okay, if you want to outperform the market, you realize that there's only about 10% of stocks out there are really going to outperform by a wide margin. And in order to truly make good money, you have to be in some of them. Okay, it's really hard to make a living at trading if you're just going to peck away and make 3 on your winners and lose 1 on your losers and do 100 or 200 or 300 trades. It's really hard to make a living doing that. You need an outlier trade every once in a while. You need to nail a big one every once in a while. Okay, every once in a while you got to nail 100, 200% move. Okay, that's why average wins doesn't make any sense, because small win, big win, and if you average those, it doesn't make any sense. But in order to truly do well in the market, you need to nail a big one every once in a while. In order to nail a big one, you have to be on the right side of that histogram. And I'm showing you what I do in order to identify stocks. I'm looking for stocks that get above a certain significant moving average on its weekly time frame, trade in some sort of a pattern, and then break out from that pattern, or maybe just test the moving average and then break out. And that's like, that breakout is the official beginning of the uptrend. Everything that happens before that breakout is just potential. Like maybe it has potential. I'm sitting there looking at it thinking maybe it has potential to move up. But when it breaks out, to me, that's like, all right, this weak stock based for who knows how long, many months, and it's trying to move up. And then when it breaks out from a pattern like this, like that's the official, like, all right, downtrend over, neutral period over, it is officially uptrend, and you want to be in it with some size, and you want to be able to ride it, because again, if you really want to outperform, you got to nail the big one every once in a while. Okay. All right, let's move on to another one. All right, SCX, Suncoke Energy. All right, so stock was really weak. It got crushed, actually. I mean, it fell from, on this time frame chart, it fell from 17 down to like $2. Obviously, it just got annihilated. Forms a little bottom, jumps up. I'm not even paying attention to it. It would never even appear on my list at this point in time. But then out of nowhere, it forms big volume and gets above its 30-week moving average. Okay. At that point in time, it would appear on my list because I would do some sort of a volume search and, give me all the stocks that are up on big volume, and it would appear on my list. And I would say, okay, here's a really weak stock that's trying to neutralize and turn the corner. So I'll start watching it. And then as I watch it for a few months, I realize it's forming a pattern here. We got easily definable resistance up here. The stock finds support at the 30-week moving average, like here, here, and again here, and then eventually moves up and breaks out on more volume. Okay, so how I would play this is it's not even on my radar during this time in early 2016. It wouldn't even appear on my radar until it actually gets up here, until it's actually already doubled or tripled. But then as I continue to watch it, and I realize there's down volume is very weak. There's some couple big positive volume bars in there. I realize that, hey, this stock actually is starting to turn the corner. It's definitely neutralized, and it looks like it may be moving up. So I'm looking to buy at the bottom of the pattern. You can see here, $5 here, $5 here. So you have a nice whole number along with the moving average. So I'm buying at the bottom of the pattern with tight stops. And then if I prove to be right, then I'll add. Okay, so if it goes against me, I'm going to lose small, and if it goes in my favor, I'm not only going to win, but I'm going to win big in terms of my size is going to be bigger and the number of points I get is bigger. So I could lose small 4 or 5 times in a row, and then one good trade will counter all those losses plus some. Okay. This is what I would consider to be like a pretty clean, simple, somewhat mechanical, somewhat stress-free trade. Okay, and you can see how somewhat smooth it shows up on the weekly chart. Sometimes you look at the daily and there's gaps. Sometimes there's just more intraday, because of the intraday volatility, you get more tails on the candles and such. But this is an example of, all of these, I guess you can say, are examples of how the weekly chart will smooth out the action. And this kind of looks pretty smooth and pretty and kind of stress-free. All right, let's look at a few more examples. Actually, I said before I go into this one, I should say, like, this doesn't just work for small companies. All the examples I've showed you so far have been stocks that were beaten down and were only trading, maybe they bottomed at, $2 or $3 or $4 and then popped up to 5 or 6, and then you got a good entry and they ran up to 10 or 15 or something like that. But this doesn't just work with those types of small companies. It works for big ones. Okay, it works for big caps. Okay, you're not going to get the same percentage moves, but you will get very good risk-reward setups. Okay, here's 3M. It was in consolidation mode, okay, when it started adhering to its 50-week moving average. Okay, this is the 50-week instead of the 30-week. As I've said before, each stock has its own personality. It kind of has, it's in tune with its own moving average. I start with the 30. If it looks good, I go with it. Sometimes I got to zoom in a little bit with the 20, sometimes back up a little bit with the 50. Play around with it. Play around and see which one makes the most sense for each individual stock. All right, so the stock did a little double bottom here, traded up through the moving average. After showing that the moving average had some significance, it traded up through the moving average. You can see here it moved up for almost 2 straight weeks. Volume was huge. There was another surge of volume over here, which pushed it up to its high. I don't know why I have this resistance 180. Resistance 180 is where we got in on the breakout. So at that point in time, I'm saying, hey, this stock, which was very neutral because it was trading sideways, definitely has gathered some steam. It rallied up, volume was good. It took out 2 previous highs. At that point in time, I'm looking to buy a pullback. and you can see what happened. We pulled back, we got close. We basically pulled back to the previous lows, which at the time happened to coincide with the uptrending 50-week moving average. And so what I'll do here is I'll zoom in with an intraday chart. It could be the 60, could be the 30. I could even go down to the 15. I'm just looking for a better entry. Okay, you don't want to pinch pennies on the entry. I know a lot of traders who zoom in too close and they want a perfect entry and they end up not getting in. And because they didn't want to pay an extra nickel or dime or something, they ended up missing a big move. But I will zoom in on an intraday chart to try and find a good entry to see if there's some level that is pretty significant that doesn't show up in the daily or weekly. So in general, I'm looking to buy a dip within the pattern with a tight stop. If it doesn't work out, I'm out with a small loss. If it works out, then I'm going to hold and look for opportunities to add to my position. So in this case, I'm buying a dip. It moves up, solidifies resistance here because it comes up and pretty much matches the previous high. It pulls back one more time and then rallies through resistance and continues on up. Okay, pretty simple, pretty stress-free. It requires patience. I think it should be intuitively obvious that it requires patience because from the initial entry in October, it took all the way until the following summer for the trade to play out. But that's what I'm looking for. Okay, that's what I'm looking for. I'm not a fast trader. I don't want to be an active trader. I want to find trends, and I don't care about the beginning and end. I just want to nail a chunk in the middle. And my way of nailing a chunk in the middle is to use the weekly charts and to find good entries and good entries that have low risk using some significant moving average as a guideline. A couple more examples here. Let's see. So I got about 10 minutes to go, 12 minutes to go. All right, so here's Apple. It adhered pretty well to its 30-week moving average. Okay, you can see support here in early 2015, resistance here in late 2015, kind of sloppy resistance here. Then it gets above its moving average on a pretty big spike in volume, not gigantic, but its biggest weekly volume candle in like almost 3 months. It gets above the moving average. Okay. At that point in time, it shows up on my radar. It's a stock that's probably on my radar anyways, but when it does that, I say, okay, maybe game on. Maybe we have an opportunity to trade this. Okay, and again, I don't pick bottoms. I'll let others do that. Okay, so after getting above the moving average, it came down and successfully tested it. Okay, so after kind of showing that the 30-week was significant here and here and here, it gets above it on volume, and then right here, if it's not solidified at that point in time, it certainly is solidified after that it came down, tested it, and exploded off it. And if you didn't get in there, you had one more chance 2 months later where it came down and didn't quite match that level, but it did come down to the moving average, and then it was up, and away from there. Apple's one of the largest companies on the planet, yet it's still rallied over 50% over the course of 8 months. Okay, to me, this is a no-brainer. Okay, like to me, when I say it's a no-brainer, what I'm saying is trading takes guts. It takes courage. Okay, when conditions are right, and you get an opportunity to enter a position that has big upside and very little risk, you got to pull the trigger. Okay, some work, some won't. But as long as you cut your losses when they don't work and you push it a little bit, like add your position when they do, you'll do well overall. You can have a winning percentage of 30%, and that's actually good enough. Small loss, get a good entry, add to it, and nail a 30, 40, 50% move, and one big win takes care of many losses. Both Apple and 3M were recommended at Leavitt Brothers. Okay, in fact, all of these except one. I think Extreme wasn't on there, but every single one of these I'm just pulling off of our service from the last few months. Actually, last year, because Apple goes back to last year. Let's look at one more. What's our time like? It's 11:50. Okay. All right. Well, let me do one more here. Okay. So UNT, Unit Corp, was another stock posted at Leavitt Brothers. It had fallen from 70 down to $5. Obviously, the company was undergoing a lot of trouble. As I've said many times, I have no desire to pick a bottom, so it doesn't even appear on my radar until there's a move above the 30-week moving average, okay, or some other moving average that has proven to be significant. Then the stock, so we get a move above the moving average. Volume was decent, but not necessarily great. At that point in time, I don't know if it's going to be the type of stock that goes up to like 20 and then comes back down to 5 and goes up to 20 and goes back down to 5. And who knows, maybe it spends the next 2 years just trading in a range and above and below the moving average. And the moving average will just be this flat line right in the middle. Okay, that's possible. Okay, so it's not really until it rallies all the way up to here, which is close to the previous high, which kind of gets my attention, because if it was really weak stock, it would put in like an obvious lower high, and the fact that it rallied so much to almost match the previous high, you know, it gets my attention. Then when it comes back down and successfully tests the 30-week moving average, that's when I say, okay, weak stock had been neutralized over the course of an entire year, because right here is August, right here is August. So I spent an entire year basing, finds support at this moving average and starts to move up. Okay, I'm zooming in here with an intraday chart to look for a good entry, and I'm looking for an opportunity to add that if indeed it actually breaks out, then I'm going to add to my position, and my stop is just going to be above the moving average. Okay, so I'm in here with a tight stop. It goes up. As it turns out, the stock just kind of grinded up, down, up, down, up, down. It didn't really break out and surge like you'd like it to, but because it didn't fall much and the moving average was trending up, I really had no reason to cut it loose. So it's you get in, you put a stop in place, and you let it go. And as it turned out, that it kept grinding up, and eventually it kind of hit an inflection point and moved up. So if you're looking at your entry down here near like maybe 13, 14 bucks, you doubled your money. If you didn't even get in until like the trend line was taken out, you still made like 50%. Okay, this is an example of a stock that was on the far right side of the histogram. Okay, the S&P moves up, whatever it moved up, 10% over the course of these several months, but this stock doubled, okay, almost tripled, depending on where your entry might have been. Okay, money rotates around like that. Okay, when I say over time, a small percentage of stocks outperform, I'm not saying buy a stock and let it go for several years. I'm saying like over the next 6 months, a stock is going to double, but then you're going to want to rotate money out of that and put it into a new stock, which is about to double. And then after 6 or 8 months, you're going to want to take money out of that and put it into the next up and coming stock. Okay, to me, this is as perfect as it gets. Okay, the weekly chart smooths out the intraday volatility. You find a moving average that seems to be in tune with the stock. You look for a move up. You look for evidence that the moving average is going to support the stock. You look for a good entry that has very little risk, and then you go with it. You look for opportunities to add to your position, and you recognize from the beginning that trading is a game of losses. Trading is a game of making mistakes, and if you can control the mistakes and push it a little bit with your winners, then you can make money overall. Okay. I'm going to wrap up here. Okay, so I've been running Lever Brothers for 15 years. I have hundreds, probably thousands of examples of charts like these from over the years. Even if you're a shorter term trader, it's good to analyze the market from this viewpoint, okay, using a weekly chart with a significant moving average. Okay, once you've established that a stock is trending up, it's much easier to zoom in with the daily or 60 and have confidence buying a dip when you know there's a gentle breeze at your back. You know, for example, even if you're a day trader, you're the type of person who wants to buy a dip and ride it for 2 or 3 days. Well, buy a dip and ride it for 2 or 3 days in a stock that has proven to be trending up on its weekly time frame. Okay, because your odds of success there are much greater. Okay, so let me review. All right, to me, trading is a big game of follow the leader, and I'm not the leader. Okay, I'm the follower. When big institutions that have multi-million-dollar research departments buy and sell, they leave footprints in the charts. My job, my goal is to find those footprints and follow them. When they buy a stock, they collectively buy tens of millions of shares. And in doing so, stocks act in a certain way. Okay, in part 1, I talked about being patient, only trading the very best setups, and trade like a poker player. Okay, when you aren't in a good position, fold and lose small, but when you are in a good position, press it and bet big and win big. Okay, your winning percentage doesn't have to be very high. You only need one really good trade every once in a while to make money overall. In part 2, I talked about how most stocks will be on par with the market and only a small percentage will outperform by a noticeable amount. Okay, you should stick with stocks that are on the far right side of the histogram. Okay, I talked about how to find these. And then today in part 3, I talked about a real setup on a longer term weekly chart that gets the odds heavily in your favor. And it gets the odds heavily in your favor if you trade it properly. If you take small losses and push it, your winning percentage won't be above 50%, but you'll make money overall. Okay. Okay. Let me wrap up here. A couple other points, like you don't need to do hundreds of trades. You just need to do a couple good ones every once in a while. Okay, and then once you get those couple of good ones, you need to maximize the opportunities. A lot of traders know that, like, okay, I get it. I should, only trade the good ones. And once you're around for a while, you realize, yes, I should, keep my losses small and let my winners run. Most don't fully realize that if you really want to make good money, you don't just ride your winners. You have to actually push it with them. Okay. If you have just like a poker player who has a great hand, it's kind of unacceptable to only win a small pot. Like, you have to strategically push it in and take advantage of that opportunity. Okay. And with that, I'll wrap. Again, my name is Jason Leavitt. I'm the founder and head of research at Leavitt Brothers. Leavitt Brothers is a boutique research firm which offers market analysis and trading ideas to investment advisors, hedge funds, and full and part-time independent traders. We solve the problem of knowing what side of the market to be on and what to invest in at any given time. If you want a free trial to our work, just email me. Okay, here's my email address, jason@leavittbrothers.com. That's it. Just send me an email, say, hey, I saw your webinar, give me a free trial, and I'll set everything up for you. The reason I'm doing it like this instead of just giving a blanket free trial to everyone is because I'll, if you really want to check out our work, if you're interested, then just it's a small hurdle to climb to actually just send me a quick email and let me know who you are, and I'll set everything up for you. And if our service could be beneficial to you, then you could subscribe at some point in time in the future. If it's not for you because you trade a different way, that's fine too. It doesn't hurt to check it out.